I'm going to have a look at chart patterns, the supposed psychology behind chart patterns, and also the reliability of chart patterns. The information that I'm going to present today is explained in far more detail in my first book, which is here, Technical Analysis and the Active Trader, which is still available. It was published about 8 years ago now. Now, chart patterns are heavily used and promoted in the financial trading industry. And it's important to understand a couple of things about using chart patterns. Importantly, you should only use chart patterns if you are convinced and assured that they are created by the psychology of the participants of the market. Now, I say that because we know that any information, any data that is put into a chart will create patterns. That could be rainfall, it could be sunshine hours, it could be the performance of Liverpool Football Club. If you chart any information, you'll see patterns, including this pattern. We're told by the people that believe in chart patterns that the difference in the patterns that they use and patterns that are created just in any kind of data that's put into a chart is that theirs are created by the psychological factors of a market, people buying and selling, and it's that interaction of people that they claim means that there's real psychology behind the patterns that they then use to trade with. And if I want to give an example, and please, the websites that I use here, I'm not criticizing the sites themselves or the people that write in them. I'm just using them as good examples actually of what they're saying. So here we have a chart pattern, the head and shoulders, and we see a left shoulder, head, and a right shoulder. And then we look here, and this is the explanation, and this is the chartist showing us the psychology that belies this, underlines this particular pattern. So the left shoulder, there's all sorts of talk about here, the consolidation after a move higher. They're talking about the positioning of people. Most traders are long and holding here. It talks about the lows of the pullbacks. If we then talk about the head, the top part of the pattern, he mentions here talk about greed and fear, which are classic statements or phrases that indicate psychology. And it then talks about the bulls and the bears and how they're interacting with each other. So again, we have the psychology being presented of what's actually going on here. So he's not just saying this is a pattern, he's saying there are actually, this is the way the people are interacting here, and that's why this pattern is created, and that's why there's some psychology and basis behind this pattern. And again here, there's the right shoulder, the bulls are disappointed, he's saying, so therefore there's the fall, etc., etc. So they claim and they provide this story behind the pattern that is, in this case, the head and shoulders pattern. And we'll go look at the head and shoulders because that's the one that we're told is the most reliable. So we might as well investigate the head and shoulders. So here we are. We're now armed with the psychology. So they're saying this is not just created by any kind of random of inputting of data into a chart. There's actually psychology of the participants working, bulls and bears, greed and fear, all those kind of terminology that we regularly hear in the markets, and that creates this pattern. Now, we'll also underline a couple of other points about a head and shoulders pattern. So we have a left shoulder, a head, and a right shoulder. This line here is called the neckline. The pattern on the way down here needs to break the neckline to be properly formed as a head and shoulders pattern. If it hits the neckline and then bounces up, then the head and shoulders pattern is said not to have formed. We only are told to trade it once the neckline is broken, then it's formed properly. And then in this case, it's a head and shoulders top pattern, so the market should fall. They also give us an objective, how far it should fall once this neckline is broken, and that is a distance. If we measure this neckline here, which is below the two lows of the shoulders, the distance from the top of the head to the neckline, this distance here, we then use that distance from when the neckline is broken, and that gives us the target we're told. That's a target. So that's a classic head and shoulders pattern there. So we're told how it works, and we're told the psychology of it, so now we understand a little bit more about it. And then just to show from another technical analysis, this is a failed head and shoulders pattern. We have a left shoulder, we have the head, he's shown us the right shoulder, and here's the neckline here. It's not a sloping one, it's a flat one. But here we can see it's hit the neckline, but it didn't break through. and it's therefore rallied after that. So the technical analysis, the chartist would tell us, well, we shouldn't have shorted this one. This is not head and shoulders. And it's at that point that we hit the first hurdle with the psychology of the head and shoulders. Go back to what we're told here about the psychology of the left shoulder, the right shoulder, the head, the psychology behind what's going on. And it's that psychology we're told that produces this. But when we look at the failed one, surely the psychology of the left shoulder, the head, the right shoulder, for most of this period, has got to be the same. It has the same type of formation, the same shapes we're seeing. So if we're going to explain the psychology of these head and shoulders in these terms, and it's that psychology that's then is the creation of the head and shoulders pattern, why is the psychology different in this pattern? The psychology of the pattern is the same. The only difference between the failed head and shoulders and a successful head and shoulders is what happens at the neckline. Therefore, the only thing that is important is whatever's going on in the market at this point in time. The previous information and this movement here and this movement, sure, we can create stories for it. We're all good at creating stories for things that have happened in the past. You can explain psychology if you want to put it in these terms as technical analysts such as this guy has done. But the reality is that a successful head and shoulders and a failed head and shoulders can have exactly the same pattern. Exactly the same. This one here is a successful one. I draw it myself. The difference between a successful one and a failed one is simply the fact, if we go to the next one, if it hits it and fails, it's a failure. But as I say, the pattern preceding it can be the same. Therefore, the psychology of why this is created can't have impact on what's going on whether it's successful or whether it's a failure, or in that terms, whether it's a head and shoulders pattern. The only thing that is interesting is what is going on here at this point in time. So, in that way, the psychology, in my opinion, is just simply not true. It's just an explanation for what they see. But the very fact that they say it has to break this point in order to be successful tells me that the only thing that's important is what's going on here. If there's good news in the market, this thing's going to go up. If what's happening in the markets is bad at that time, this thing will fall. It's got nothing to do with the preceding pattern. I say again, if you don't believe the psychology behind the creation of these heads and shoulders, if you think that that's just an explanation, if you don't believe that's the real psychology of people and what's happening, you cannot use not only the head and shoulders pattern, you cannot use any patterns. Otherwise, they just become like any other pattern in data. Another thing that we're told is that head and shoulders and chart patterns in general are successful. They work well. Well, let's have a look at the head and shoulders pattern from the perspective of some independent studies that were conducted into it. Now, when I researched technical analysis on the active trader, I found some sites and some supporters of this pattern claiming it had a success rate of over 90%. I found references to it being called the Labrador of trading patterns. It was reliable, like a Labrador dog, apparently. Well, I must admit, not like my Labrador dog. But we're told it's a reliable pattern. Well, this was investigated in two studies, both conducted by the Federal Reserve Bank of New York. The reason why the Federal Reserve Bank of New York was investigating chart patterns is partly to do with their role as overseeing markets in New York and financial markets, and they like to know about the different participants in that market. How are they trading? What could cause issues in markets? So I think it's a really fair thing to investigate the head and shoulders pattern. So the first study that was conducted on currencies over a period, I think it was about 12, 15 years. In total, 164 trades, head and shoulder trades, were entered into. 90 were clear losses. That's 55% of the trades were clear losses. 59 trades, or 36%, were clear profits. 15 trades had profits that were marginally greater than zero. However, if you factor in the costs of trading, commissions, that sort of thing, in my opinion, they would not be profitable. They were marginally greater than zero. So after commissions and costs, I reckon that they're not profitable. Interestingly, on one currency, I think it was the German mark, um, over a 10-year period, there were no clear winners. And I think it was about 14 or 15 trades were entered into over 10 years. None of them were winners in 10 years. And the other point they found was when looking at that distance of the neckline that we're told about, and that's the target that a completed head and shoulders pattern should achieve. What they found with completed head and shoulders pattern was that 73% of them failed to meet that objective. So the risk reward characteristics that you have when you're setting this and you think you've got this amount of reward, if we go back to the neckline and we look at this target and we think, okay, that's our potential reward, and people can think they can set a risk reward around that, they found that 73% of them did not achieve this target. A second study, also by the Federal Reserve of New York, was conducted a while later. This study used 31 and a half years of data on 100 different stocks in the US. At the end of that, they found that the average result, or the average per trade, was a loss of 0.24%. So the average trade of using a head and shoulders pattern, you would lose money. And those people that were using the head and shoulders pattern were classed as noise traders by the people that wrote the study. Noise traders, for those that are not aware of the concept of noise, a noise trader is someone who is trading on what they falsely believe to be information, but it's actually noise. It's not going to lead to any profit for them, and it's not reliable. They usually believe that it is reliable. In this case, because they've probably been on a technical analysis course, they've been told it is, so they use it. But actually, it's not. It's unreliable. It's going to lead to losses. And these traders are called noise traders. And it should go without saying that we do not want to be noise traders in our careers. We want to trade on information. So let's have a look at this head and shoulders pattern again. In summary, we need to believe that this pattern was created by psychology. If we doubt the psychology behind it, we cannot use any pattern. Sure, sometimes you might see a pattern like this form and the market falls, and you want to relay that fall back to the market. Humans like to work in that kind of a way. I see this pattern, this then happened, the pattern must have caused it. Humans like to work in that simplistic manner. But as traders, we have to get away from these rules of thumb and move to more reliable methods and analysis. If we doubt the psychology behind these patterns, we cannot and should not use them. And as I have explained, the psychology of this pattern, this left shoulder, head and right shoulder that we've explained in a successful one, must be exactly the same in a failed one. The only difference is at this neckline point. So as traders, what we need to be trading in is not in the past in what these people here have done or these people here have done. They may not be here anymore. We need to focus on the now, what is happening now, because that's going to tell us really what's happening here. Nothing to do with the preceding pattern. So the psychology we explained cannot and is not reliable or correct. Therefore, we should not use not only head and shoulders, but any of these chart patterns. They are shortcuts. Secondly, as I've explained, the success rate in independent studies. So these people, they're not trying to sell books on chart patterns. They're not trying to sell courses on chart patterns. They're just trying to investigate, why do people use them? Are they successful? And these independent studies have found that the head and shoulders pattern is unreliable. As I say, if you would like more information on any of my beliefs or thoughts, and also the research that I conducted into technical analysis, then the book Technical Analysis and the Active Trader is full of that research. And